Welcome to this week's Markets in Focus. My name is Hamilton. I'm here at the Trading Initiative. Over the next 20 minutes, we're going to talk about the most important moves that happened this week, wrapping up March 15th, 2024. First things first, copper up 5.73%, and we are seeing a push in copper-related equities as well. As a matter of fact, materials-related equities, which we're going to touch upon a little bit later. You got the 10-year up 5.69, the 30-year up 4.17. There is some softening in bond demand, which we're going to look at as well. And does that lead into a softening of the equity market? As we've seen over the last about a year and a half, as that correlation between bonds and equities has shifted to positive. Crude oil up 3.95%. That has prompted us to put on some energy-related positions, which we'll talk about as well. And you can see that commodity index tracking fund up 2.66. Other than that, actually this week was pretty weak. As you can see, this is the second week in a row that we really failed to hit new highs in the indexes. There's a lot of underlying weakness, some rotation going on, which we're going to touch upon in a second. BTC holding up relatively well, up at that all-time high area, but still down. The S&P 500, the Qs, etc. The Russell down 2%. Not necessarily the most worst move, if you will, this week, but definitely has not been able to continue to push through with the momentum that it's had over the last few weeks up into new highs. And then obviously the 20-plus year bond ETF down 2.91, which reflects that rise in the 30-year bond yield, which is something that we have to take into consideration when we're taking new trades. That positive correlation does not look great right now, but we'll talk about that in a second. Let's go ahead and go through U.S. sector performance. We're going to start with year to date. And then we're going to bring it down into the 1 month because we are seeing some rotation. First things first, who would have put energy as the year-to-date leader? Not me. That's not what I would have expected. But that's why trading is fun, right? It's a constant puzzle. It's a mystery. We have to continue to track this type of stuff, find where the money is flowing, where the relative strength is. And as of right now, year-to-date, energy is up the most at 9.21, and it's just been screaming for the last 2 to 3 weeks, actually. Comms in a holding pattern up 9.12, financials up 8.48, SPYs up 7.26. But check out everything underneath, including tech. Yes, we are now starting to see some rotation under the surface on the year-to-date chart, showing some weakening in the risk-on areas of the market. Now, that's not to say that we are bearish on the year whatsoever. This is very normal rotation. The question that we have to ask ourselves is this a short-term, intermediate-term, or long-term sector rotation cycle we're about to go through? And I think that's important. And I don't have the answer yet. We're going to talk about that throughout this video. Industrials up 7.06%, healthcare up 6.58%. It's been a pretty good year so far. It's actually been up until Friday's close. It was the 7th best start of the S&P 500 in the last 80 years. So if you missed it, obviously you're probably upset. If you didn't miss it, you probably are sitting very, very healthy in any of your trading accounts right now. But we are starting to see some weakening in some of the leaders. We're starting to see that rotation. If we bring it down into the 1 month, we can see very clearly that over the last month, energy is just outperforming everything. Materials outperforming everything, 9.92 and 9.20. Utilities, generally a defensive area of the market, up 5.26. Financials up and over 4%. Staples up over 3%, almost 4%. But look at the bottom there. We have tech, consumer discretionary, and comms. And those are the risk-on areas of the market. Those are your software names. Those are your social media names. Your consumer discretionary names, like Tesla and Amazon. They're really underperforming over the last month. This is patented growth into value sector rotation. We are starting to see some defensive posturing in the market. Not only is it being reflected in the 1 month, but it's also being reflected in the year to date. And that's something as traders, we absolutely have to identify and potentially start taking positions when that 1 month starts to bleed into the year to date, the 3 month, the larger time frames, right? What we're going to do here is we're actually going to look at the U.S. industries as well. We're going to look at these from year to date and then niche down. What you're going to see probably isn't going to surprise you considering what we just saw with U.S. sectors, but semiconductors taking a little bit of a pullback here, a little bit of a breather after a monster run year to date. They're still up 24.57%. These are still very clearly the market leaders, but they're frothy, right? Particularly over the last week, they pulled back quite a lot after ramping up through the first 2 months, 2.5 months of the year. Still expect them to lead throughout the year, but it's not going to be the easy trade that it has been. I don't think. It's very frothy, very prone to whipsaw type of price action. I think people are going to have a harder time establishing new positions in semiconductor names as opposed to what they've been able to do over the last 4 months, going back to those beginning of November lows. But once again, looking at some of the more risk-off areas of the market hitting new highs, we have insurance, we have AMLP, which is your oil, gas, and pipeline, and some other unrelated oil-related names. XOP, or oil and gas exploration and production, all 4 of these up and over SPY, but wait till we niche down into the 1 month. So once again, we're starting to see that rotation out of some risk on areas of the market into some risk off areas of the market. Going back 1 month, we see GDX, gold miners, gold into all-time highs. GDX is not the easiest trade, but it is up almost 15% over the last month, and that's kind of what you would expect in a market that, one, is buying gold, and two, is more defensively posturing in towards the end of Q1 here. Oil services, oil, gas, and exploration, rounding off the next two. So your top three up there, all three of them are more risk-off areas of the market. When energy catches a bid, it's generally at the cost of risk-on areas of the market. Money is generally going to be moving away from the higher beta names and in towards some of those lower volatility energy-related stocks. And obviously, if we compare that with a rising price in U.S. oil, because there is a positive correlation between the two, we should probably be looking at getting long energy plays. And we have over the last 2 weeks. We're going to go through a couple of those towards the end of the video. At the bottom of the list here, though, we all know that clean energy and solar has just been a non-trade for like the last 3 to 4 years, but software, right? Software is down 4.21%. And a lot of that is Apple. Let's just be honest. Apple has really just killed software right now for whatever reason. The market doesn't love it, but that's bringing a lot of these non-equal weighted ETFs down a lot. So we're not interested in buying dips. We're interested in buying stocks that are still outperforming. And as of right now, that's going to be your lower volatility areas of the market. Really quick, let's look at factor analysis to get a general idea of what areas of the market from a market cap standpoint are really starting to shine through. And once again, we're seeing a lot on the year of large cap and mid cap stuff start to move. Mid cap, I think, was probably the best trade that we've taken as a group this year. We grabbed a lot of semiconductor plays, which were they've worked very well. Don't get me wrong. We have a bunch of free positions in those, but our ability to grab the mid cap, particularly those IPO range breakout high trades that you see us post all of the time, they are just working like crazy right now. So if you don't know what that is, go through some of the content that we've been putting out lately. Those IPO range breakout highs, find how to scan it for those mid caps, particularly mid caps. They're going nuts right now. The rest of the market, though, underperforming the S&P 500, they are starting to tick up. Let's look at the 1 month here. And once again, we are starting to see that defensive posturing, right? So large cap value is now outperforming SPY over the last month. And generally speaking, that makes it a lot harder to trade some of the higher beta areas of the market, right? So if you're sitting here thinking of different types of positions to be putting on the books right now, the strength, I'm not saying this to influence your decision, but the strength right now is going to be in the large cap value areas, in some of the mid cap value areas, et cetera, right? It's not going to be the higher beta growth stuff anymore. Not to say that it can't be in the future. As a matter of fact, that's a question that we have to ask ourselves throughout this entire video here is this going to be a quick rotation, or is this going to turn into something like 2 quarters worth of rotation, 3 quarters worth of rotation like we have seen before in the past? I don't know what the answer is yet, but we are starting to establish positions in the lower volatility areas just in case. Really quick, I want to point out from our Twitter segment of this Markets in Focus video, Almanac Trader. I'm an absolute huge fan of the stock trader Almanac. If you like data and you can pull your opinion and bias away from some of the raw data, I absolutely encourage you to purchase this. I think it's $40 or $45. It's amazing. But here is his breakdown on March market performance over the last 21 years. So 2003 to 2023 and into 2024. And you can see kind of the average run on all of the major indexes here. And one thing that he points out is essentially Friday, the 15th, is damn near the low of whatever pullback we got that supposedly was going to start in February that actually never ended up manifesting itself. So on average, the Ides of March, if you will, is around the time the market starts to bottom out, if it is starting to pull back before catching a bid again until about May before we get seasonally another pullback. Now, it didn't really play out last time. Just be straight up. February did not give us the pullback that we had actually expected. We were still able to remain long and make a couple bucks, but we were expecting a hell of a lot bigger firework event. We were expecting a big pullback to be able to buy the dip, and it just never came. So, Jeff here is kind of thinking to himself, if February didn't offer a pullback, are all of the dates going to be rolled forward? Do we still have some seasonal weakness ahead of us in March because it didn't occur in February? And I think it's a very valid question to ask, especially if we're seeing risk off areas of the market catch a bit, right? It's just not the type of environment that is conducive with throwing large amounts of cash into higher beta stuff if the lower volatility names are breaking out and the indexes are showing some cracks and weaknesses, which they absolutely have over the last 2 weeks. So shout out to Jeff and his Stock Trader Almanac book. Absolutely awesome material there. Let's move to TradingView really quick, and let's go through some individual tickers here. The first one I want to go through is just the indexes SPY. We're going to go through these, and I want to point something out here. Like I mentioned earlier, this is the seventh best start in the last 80 years for the S&P 500. So for people that missed it, they're probably ornery and upset. Totally understand. But for those of us that didn't, that we're just kind of giving ourselves to the trend and remaining long, this has been a very, very good start for us. I think it's important for all of us to understand that there absolutely could be a pullback within this broader trend to the upside, and it could be particularly nasty and still remain in a primary uptrend. So primary uptrends take quarters to form. They're very slow moving. We're now in year 2 of something called a cyclical bull market, right? 2023 was year 1. Into 2024 is year 2. And I think to keep things into perspective, if we took the absolute high of the S&P 500, and let's say we get a 10% correction, which happens about once a year, generally speaking, that brings us all the way back down below 478 and down into below all-time highs at around 465. Now, I do think that absolutely this could happen. As a matter of fact, I expect it to happen at some point this year. I don't think it's just going to go straight up. I don't know if we're going to get the full 10%, but I do think we're going to get a pretty nasty pullback, and it's going to introduce two things. It's going to introduce a lot of pessimism in the market. People are going to be afraid. They're going to be running for the hills that there's a new bear market coming, et cetera, and they're going to short everything. And I think that's the wrong way to play this. We're in a broader secular bull market and a cyclical bull market. And you know when the market starts to falter, everybody freaks out and runs max risk short. And I think what's going to happen is maybe in the short term that will pay out pretty well. But for the greedy bears, which I absolutely think bears are greedier than bulls, because just based off of how much money you can actually make to the short side, you have a cap that you can't go more than 100% on an asset losing its value. If it goes to zero, it's out. Bears, famously back in 2022, a lot of the mega cap tech stocks came down 50%, and bears were still saying that they needed more. And it blows my mind, right? So I tend to think bears are a little bit more greedy than bulls, because the infinite profitability on the bull side is just mathematically easier to trade than the 100% to the downside from a bear's perspective. What I'm looking here for, though, is a pullback. And what I think that bulls are going to be able to do, as long as we can remain level-headed, is we could buy the dip at some point when we find a floor forming. And I have no idea when it's going to be. I don't even know if this is going to happen, but we're actively prepared for this inside of the trading initiative for this type of scenario to happen. And we want to be remaining on the bull side until this cyclical bull market is invalidated, which it could. Anything could happen. I just don't think it will, right? The stats here show that we're in the 4th year presidential election cycle. Things should be doing pretty well. But even within these cyclical bulls, we're going to get some nasty pullbacks. And I think, we can see that the market is very frothy right now. There's a lot of money being thrown around. There's a lot of, any of the sentiment indicators or anything, there's a lot of greed, et cetera. And we're seeing momentum actually slowly start to fizzle out here into the new highs. We have a bearish divergence on the RSI. Now, that's not an indicator just to go short in of itself, but prepare for a potential pullback and have a plan if it does happen, right? We are seeing week over week weakness in the S&P 500. We are seeing some risk off areas of the market catch a bid, some more defensive posturing. So it's important to put this in to perspective that it absolutely could happen. And if it does, just have a plan for what you want to do with it. So as of right now, the S&P 500 still looks okay, but we're seeing cracks forming. All right, if we go to the Qs, it looks the exact same, right? As a matter of fact, the Qs look a little bit worse than the S&P 500, which makes sense because the Qs don't hold energy-related stocks. They don't hold material-related stocks. The areas of the market that are breaking out into potential new all-time highs, the Qs have no exposure. So we are starting to see some weakness in the Qs. As for the S&P 500, we've yet to really start to break down, but we can see that the Qs actually placed a new low this week on Friday with its close. So we're starting to potentially see some rotation out of this. And once again, just like the S&P 500, if this falls from its absolute peak 10%, can you imagine the Qs below 400? I think if it gets down there, it's probably going to take a quick run below 400 to really scare people and sucker in a lot of shorts. Absolutely think it could happen. And if it does, we're going to be there on the bid eventually. We're not going to try to time the bottom. We're going to find somewhere it's going to, bounce and start to come back up. We're going to be buying that. I'm just telling you right now, we're going to be buyers. So the Qs, some cracks forming, and small caps finally outside of its 2-year range, but unable to really catch a bid over the last week. Just really nothing there. So if we start faltering back down below the 200 price level, do you still want to be taking new positions, long in the small mid cap space? I don't know. It's not a question that we want to attack yet because we're not down there. We still have exposure in small and mid cap. They actually are still performing well. A lot of the IWM weakness is because of SMCI and some of the other things as well. But, as of right now, it's just cautious in the market. There was a time to press the gas pedal down. There was a time to be cautious. I think right now, erring on the side of caution is probably a little bit better. Let's figure out exactly where these indexes want to go before we start committing a bunch of cash into the market. Let's talk about the equal weighted indexes really quick. People are saying market breadth sucks. It really doesn't. I don't care what anybody says. I know that you can go on FinTwit and you can find opinions on. Everybody has a different opinion, and it's okay. You can back it up. But if you just look at a basic equal weight S&P 500, so all 500 companies in the S&P 500 equally weighted, we're at all-time highs. And as a matter of fact, we're pulling back into the all-time high area, which is just some resistance and support flip from a technical perspective. Absolutely nothing to worry about in terms of market breadth. As a matter of fact, it looks pretty goddamn good to me. So if you want to find a problem with market breadth, I'm sure you can dive through and find something to justify your opinion. But if we look at just the basic equal weighted ETFs, NASDAQ as well, up and over the all-time high area and pulling back in towards resistance, now turned potential support. I mean, market breadth is still there, which makes sense, right? It makes sense. We're up at all-time highs on both the indexes, equal weighted and non-equal weighted. We're seeing sector rotation and certain sectors break out into all-time highs. It makes sense that equal weighted ETFs should be up near all-time highs or at, which they are at this point, because sectors are rotating into all-time highs. So they're picking up the slack from other sectors that potentially were leading before. Let's look really quick at high beta versus low volatility, because I think this is important. So for the risk on, risk off narrative that we've been talking about in this particular video, we would expect higher beta areas. If they were outperforming, this ratio would be moving up. Now we are sitting at all-time highs right now. We're pulling back in towards that resistance turn support, but this is a ratio chart. It's a little different, right? So we're taking the absolute performance of higher beta stocks and we are dividing them by the absolute performance of lower beta stocks. And as of right now, we're still holding up and over all-time high for higher beta versus low beta stocks, but their cracks are forming. We're seeing the sectors start to rotate. Does this ratio fall back under the 1.25 area? I absolutely think it does, or it could, excuse me. And if it does fall below 1.25, we have to start thinking about what we want to do with the higher beta positions in the future. Not necessarily close the stuff that we already have, particularly if they're free trades, but do we want to continue to put cash into those if the market is very obviously rewarding the lower beta, lower volatility breakouts? This is an important conversation to have internally. We're having it inside of the trading initiative. The whole goal is we want to put our new capital, like the capital that we have in the accounts that's not locked up into trades right now, into the highest probability areas that the trends are going to sustain themselves. And as of right now, we're seeing that rotation. We're seeing the cracks form on the index level. We're seeing, for example, this ratio potentially start to break down, right? Kind of building this narrative here a little bit that maybe it's time to start looking at some of those lower beta and lower volatility names. On top of that, if we look at TLT, which is your 20 plus year bond ETF, this has just been absolutely thrashed going back to 2020. Now, we did have a correlation flip, right? So over the last 30 years, bonds and stocks have moved the exact opposite. There was an inverse correlation between the two, but about a year and a half ago, they flipped, positively correlated. Bonds and stocks have been moving in the same direction. And so what we would have expected in a market that wants to continue to go up is bonds to catch a bid and go up, but they haven't. As a matter of fact, since the end of December, bonds have been now at this point in a relative downtrend. So they are now in a short-term downtrend, intermediate downtrend, and they're still in a primary downtrend. This is not looking great for bonds. We're below the 200-day moving average. We have a line in the sand for bonds at 92. We're currently trading 92.94. When bonds are going up, the market tends to go up better, at least over the last year and a half. Right now, bonds are not going up. So it doesn't surprise me to see the market start to take a breather as well. It just doesn't surprise me. This is the relationship that we've noticed over the last year and a half. Everybody's talking about it. It's real. It exists. So here's a question for you to ponder. What happens if the bonds break below 92? What happens if TLT starts to break down into new lows going back 4 or 5 months? Does that kind of ruin the party for the equity game? I absolutely think it could. I don't know if it's the only thing that's going to ruin it, but look at the 30-year yield. What happens if we break back up and over 4.5? Which it could happen if TLT loses 92 and really starts to take a dive down and the 30 years up at 4.5. What does the equity market look like in that type of environment? It's fundamentally different. It's going to trade differently than what it's been trading like over the last few months. It will. These will impact the equity performance side. So think about this stuff. Really quick, I want to point out a couple sector trends that are starting to break out into all-time highs, probably because most of us don't have a lot of exposure. Energy. Going back to 2022, we're stamping out a potential new 10-year high. 10-year high, and then we're very close to an all-time high. We go all the way back to 2014. You can see we had a little pop-up here. In 2014, we're now pressing into overhead risk on level, right? We have this resistance area here that we've pressed into since 2022, and we've just been screaming up there over the last 2 weeks. What happens in a world where energy breaks out into 10-year highs? Is that conducive to buying higher beta stocks, or should we be focused more on the lower volatility energy-related things? Question to ask yourself. You're going to look at two energy trades in a little bit. Financials are breaking out into potential all-time highs. There was almost an all-time high close just a few sessions ago, right? We have some financials on the books. Right now, we've been holding them since the end of December, beginning of January. What does the market look like when financials are breaking down to all-time highs and there's weakness in the tech sector? Should you be looking to open up financial-related names or continue to open up those tech names, those consumer discretionary and those calm names? As of right now, ask yourself, which one looks like the stronger trend? We can look at materials. There's an all-time high close in materials. Once again, this is lower volatility, not sexy stuff to trade, but we are getting the breakouts in some of the sectors that most people aren't even aware that they're around. Most people only know growth in tech. But what happens if I'm showing you right now, materials are breaking out to all-time highs, and there's a slew of industry groups within materials: gold, silver, steel, copper. A lot of different things that you could be trading here. We're going to look at one at the end of the video. But here's your wake-up call. We have energy screaming up near all-time highs. Financials are near all-time highs. Materials are at all-time highs. And then XLI, which has just been into all-time highs since the end of 2023. How many people are trading industrial-related names? Not a whole lot. This is kind of a catch-me-all sector. There's a lot of different industry groups in there, but these are less sexy areas of the market to be trading. These are not your Apples, your Microsofts. These are not your Teslas or your Amazons, but these are working right now, so maybe you should be focused on those. Really quick, we're going to look at Bitcoin. All-time high breakout. Awesome to see. Is it still a proxy for risk on? Probably. It probably is. It's a lot more volatile, prone to whipsaw, liquidity issues, etc. We like BTC. We think it's going to hit 100K minimum. I think that's the minimum that it's going to hit this cycle, just based off of primary trend and fib. So don't shoot the messenger here. I don't care if you like the tech or not. It doesn't matter to me. What we're looking for is a potential shot from about 69, which is that overhead resistance area, up towards about $100,000 minimum. Probably will overshoot that, but it's not just going to go up in a straight line. We think we're at the beginning stages of a primary super cycle for BTC, and this is how this stuff generally works. If you think about it in baseball terms, we're probably in inning 2, end of 2, maybe beginning of 3. So we're not right at the very beginning, obviously, but we're thinking there's some more upside there in BTC, and with that, Ethereum as well. Looking at total market cap really quick for the crypto market, you can use TOTL for that. We're not even up near all-time highs in the crypto total market cap. How long is it going to be to get up and over 3 trillion? We think it's going to be relatively soon. There's liquidity still entering the market. We think it's going to be 3 trillion. And in a crypto market where there's $3 trillion floating around, what is Bitcoin's valuation? If right now it's sitting around 68,000 and we still have another, $500 billion to throw into this, BTC is probably going to be up and over 75, closer to 80. And obviously we think, just like the primary trend to the upside in BTC's price, market cap is probably going to shoot up as well. We have no idea where it's going to go, 4, 5, 6 potentially. One thing I want to point out for everybody that's obsessed with crypto, Microsoft's total market cap, just the one company, is worth more than the entire crypto universe. Just want you to understand that. Let's be humble a little bit. A couple trades here that we put on that I want to talk through that are taking advantage of the sector rotation. JP Morgan we put on all the way in January. It's working. We're about halfway through the metered move. This is about a 250% win for us from an options standpoint. And about a 10 or 11% move from an equity standpoint. But I think it's important to understand that we put this trade on in January. It's a 1.29 ADR. So these lower volatility, lower beta names are just going to take a lot longer to get going. It's going to be a very different type of trade than we'll say Apple or Microsoft or some of the higher beta tech names. So if you're looking to put some of these positions on, like we write up in the newsletter, set your expectations that these things could take a very long time to play out. If we click up, you can see that this thing is up, but it's up over 73 days. So if you can't hold for 73 days for a 10, 11% move, or the contracts, once again, 250%, maybe it's better to not take these trades. But you got to be realistic with yourself. Are these lower volatility areas going to give you the huge moves that you're normally accustomed to in tech? Probably not. This is another trade that we're in right now. This is MPC, Marathon Petroleum. Energy-related name into all-time high. This was actually a trade that we took last year, and then a couple guys took it again this year. This is for whatever reason, U.S. domestic energy producer leader. We're taking profits up near $200. It's going to be the first time we're taking profits on this off of the first ad. We removed half at 100%. The trade's up 350% right now, and this was before energy really started to catch a bid. We saw a little bit of demand, in U.S. oil, and so we tried to front run the MPC trade, and it worked. So we're up. We have a huge lead in MPC. This is something to watch in the future. If it consolidates, Very, very beautiful chart to be able to take advantage of. One that we opened up this week and we actually put out to the newsletter, so you guys had an opportunity to buy it as well, was Valero. Valero was another one, all-time high breakout up and over 147. We had no idea that it was just going to shoot straight up to 163, but we now have a huge lead in Valero. We were able to turn these contracts free, and they're up about 150% right now. So once again, energy, if it does break out into all-time highs, we have two positions, MPC, Valero, both all-time highs, both huge movers already. We're sitting pretty okay, and we're constantly going to be looking for more energy-related plays because Valero and MPC, although they look fantastic, they don't encompass the entire U.S. energy sector. We're looking at things like oil and gas pipeline names. I'll give you a little hint. We haven't taken this yet, but ETRN, potentially above 1150. For those of you that love Stan Weinstein Stage 2 breakouts, there's one coming up. We'll see if we can actually grab it. Last one I want to talk about in a trade that you can take with us is STLD. So this went out in the newsletter like 2 or 3 days ago. We got the all-time high breakout yesterday. This is a steel name. So this is from the materials sector. Steel name breaking out above 135. Now, most people would look at this and go, oh, I missed it. I don't think so, right? Using our BRB entry mechanism, the breakout on Friday confirmed with over 1 RVol gives us an opportunity to potentially do what? Buy the pullback early next week. So if you like steel dynamics, this is a steel-related materials play. And once again, materials breaking out into all-time highs. If you want to take a little bit higher volatility, 2.61's higher volatility for a materials-related play, buy the pullback next week. I'd be looking for a pullback somewhere around 135. Get yourself a nice little pullback. Buy the contracts following the newsletter if you want, or the shares. Once again, this is kind of a higher beta materials-related name. And then ride it for hopefully the bounce, right? That's how we would play it. That's how we're going to play it in TTI. Not everybody inside of TTI grabbed the actual STLD play as it broke out. We're just going to sit there and buy the pullback. This is what we do. You don't need to rush into this stuff. Buy the pullback, get a better fill, and then enjoy the ride if or when it works out, right? So bottom line here, if you haven't noticed, is rotation is very apparent on the 1 minute. And it's bleeding into the 3 month, into the year to date, right? Tech, consumer discretionary, and communications are starting to really underperform. Energy, materials, industrials, and financials are really starting to outperform. You have to take advantage of that or just simply sidestep it. Don't play at all. If you don't want to trade any of those lower volatility areas, understand that you're operating in a market right now that is not rewarding tech anymore, at least not yet. Not yet. The biggest question for me is not why is this happening? There's a million people out there. It's inflation. It's this. It's rates. It's that. I don't care as a technical trader. My question is, how long will this exist? How long will this trend continue to exist? The biggest question inside of TTI is it worth closing great positions in tech names that we opened in January and February that we've been able to flip for free? Should we be closing those and other growth stocks to chase the low volatility breakouts? Is it worth it? Because if this trend, if this sector rotation only exists for about a month, well, closing those great growth trades to try to chase the low volatility breakouts is going to end up being a terrible decision. It will. It will negatively impact your yearly P&L. But if these sector trends, the rotation we're seeing plays out over the course of like an extra quarter or two, then it absolutely would be better to try to sell off the growth positions for profits and then rotate some of that capital into the lower volatility stuff so we can continue to ride the trends to the upside. It's a hard question. I don't know what the perfect answer is. I think everybody's going to have a slightly different emotional response to this stuff and how they view risk. But it's a question you have to ask yourself, right? We're not sure. But if you're following the daily newsletter, which you should, links in the description below, it's completely free. You'll see how we play it over the next coming week or two. Guys, my name is Hamilton. I'm here with the Trading Initiative. If you like this type of content, please like and subscribe, leave a comment below, and I'll catch you on Monday.